Welcome back. My name is William Gomez. I am a local mortgage banker here in the Tulsa, Oklahoma area, and today I am excited to talk to you about how to access your home's equity, pretty much money that's in the walls of your house, depending on how much down payment you put in at the beginning or how long you've lived in your home, and how much appreciation has accrued over time. Today I'm going to talk about two specific ways on how you can access. The first one being a cash out refinance, and the second one being a home equity line of credit. The pros, the cons of both of them, and which one might be right for you. All right, so let's get started with a cash out refinance. One of the things that you need to know that's good about doing a cash out refinance is that it is going to be a fixed rate, meaning that if rates go up in the next year or so, your payment is going to be fixed for the next 30 or 15 years, whatever rate term that you decide to do. One of the things to watch out for whenever you're doing a cash out refinance is that if, let's say that you bought your home in 2020 or 2021 and you ended up locking in a 3 or a 2% even, and you decide that you want to access your home's equity through a cash out refinance, one of the questions that I get asked is this going to be an additional payment? And the answer is no, because it's going to replace your current mortgage payment. But if you finance your property back in 2020 and 2021, the rates that we're looking at today, which is 2024, end of 2024, is going to be a lot higher, meaning you're going to lose that low rate of 2 or 3% on that. A couple of different things that cash out refinance is good for is if you're looking to pull out a lump sum of money that you already know what you're going to spend that on. So let's say that you're consolidating debt. Let's say you have $50,000, $100,000 in debt, or let's say that you are looking to put a new kitchen in your home, a pool, or some sort of renovations. Pretty much think of accessing money already knowing what you're going to spend it on. The reason why a cash out refinance might be right for you is because even though it might up your rate a little bit, maybe not as extreme as a 2 to a 6%, but let's say from like a 5 to a 6%, it still might be the right loan for you because it's going to minimize your monthly expenses, because otherwise you would have a second loan at a higher interest rate. And the last thing that I'll point out is as if you're already a homeowner and you already have a mortgage right now, you know that at the end of the year you get a statement to be able to deduct that interest that you've paid on your mortgage on your taxes. That's a great thing about doing this as well, that if you're already planning on getting out a different loan, when you mix it into your current mortgage, you're able to deduct that interest as well. Right, next is going to be how to access the money in your walls through a home equity line of credit, or also known as a HELOC. So a HELOC is going to be a second vehicle that you're able to access money from your house without having to give up a low 2 to 3% interest rate. But that means that you're going to have an additional monthly payment every single month because your first mortgage is going to stay the same, and then you're going to have a second mortgage pretty much, and paying that back every month depending on how much you're drawing. Now, remember how I told you that a cash out refinance was great for a lump sum of money that you already know what you're spending that money on? Well, think of a HELOC as a big line of credit, okay? Like a credit card, like a big credit card that it's attached to your home. Biggest difference here is that you're going to have a much lower interest rate than a credit card. We're talking about it's November of 2024 right now, so difference right now would be credit cards are anywhere between 25 to 30% interest rate, and then a HELOC is anywhere between a 9 to a 15% interest rate, depending on where you go in your credit. Home equity line of credit is great to have even if you don't have any need for it. Why would you want to get a HELOC even if you don't need it? Well, you would want to do that in order to be able to, if something comes up, whether it's an emergency or whether it's a business opportunity that comes up, you can't grab money from the walls. But if you have a HELOC already in place, you can access that, and you can access it in cash, unlike you can on a credit card there as well. Now, your payment is based off of how much you draw. So just because you have a $100,000 line of credit, home equity line of credit doesn't mean you have a payment at all if you're not using it. But if you have a $100,000 line of credit and you, let's say, decide to pull $5,000 to buy something cash, right, that you don't want to actually touch your cash, your payment is going to be based off that $5,000. You have to remember that the payment on these home equity lines of credit and the interest rate is variable depending on the balance and depending on what the market rate is. And normally these home equity lines of credit are gonna be about a 10-year active period before they expire and you have to do them again. Right, one of the last things that I wanna talk to you about here is making sure that you know the difference between closing costs when it comes to a home equity line of credit or a cash out refinance. So normally on a cash out refinance, the closing costs are gonna be a little bit bigger because it's pretty much like whenever you first purchase your home. You're going to have lender fees, title fees, you're going to have appraisal fees, and you're gonna have to reset your taxes and insurance all over again, right? So you're gonna be looking at anywhere between $7,000 to $8,000 to $9,000 on your overall closing costs on a cash out refinance. And if you don't have the equity for that, that's whenever that can take away from how much you're actually getting back out for your project or for your debt consolidation. When you're looking at a home equity line of credit, those fees are a little bit more minimal because it's pretty much just like a second mortgage on that. So depending on the bank that you go to, those fees can be up to 1% of the loan amount, or as low as maybe even $500 to $1,000 on that. Those home equity line of credits normally have a annual fee, kind of like a credit card does. Just in case you don't use it, the bank is still making some money off of you there. But pretty big difference there. But just because the cash out refinance has bigger closing cost fees doesn't mean that you should completely write that off. It just depends on your situation. And again, I've given examples on which one would be best for you depending on what you're using it for. If you have made it this far into the video, first of all, thank you so much for staying here, and I hope that you learned a little bit of both, the difference between a cash out refinance and a home equity line of credit. I just want to remind you again that if you're planning on accessing either one of those, first of all, you have to ask yourself, how big of a down payment did I make at the beginning of the loan, and how long have I been in my house for? And the reason I am repeating that again is because if you're sitting here watching this video and you purchased your home 1, maybe 2 years ago, and you put the minimum down payment, the chances of you doing both of these are most likely non-existent. And even if you can do it, it might not be a good idea for you to do it because the equity that you have on your home is not very much. Now, if you've been on your home, let's say 5 to 10 years, or even if you purchased a home 3 to 5 years ago but put 20% down or more as a down payment, and now you're in a situation where you need to access funds, these two are very good avenues to be able to get to the goals that you're trying to do. Whether, again, a big reason of why people use these loans are, 1, they'll use them for either consolidating debt, 2, for big home improvements, or 3, a new business adventure, or maybe even to buy another property and use that as a down payment to the next home. Make sure that you guys tune in for future videos. If you found this helpful, make sure that you comment questions that you'd like to know in the future. Make sure that you like the video and that you share it with a friend and that you subscribe, and I can't wait to see you on the next one.